If you're a dividend investor, then you need to listen up. The metaphor of a magician's hands can be applied to many things. One hand distracts the audience while the other hand performs the trick. There's the flourish and there's the function, and markets tend to work the same way. Today is the day that investors and analysts have been waiting for most of the earnings season. It's the day that NVIDIA gives us its Q2 earnings and its updated Q3 guidance. With bated breath, they are waiting to see if the numbers support this month's record highs. Shares are up 33% since the last earnings season. The company earnings matter more than just to NVIDIA investors. The stock's $4.4 trillion market cap gives it incredible weight in the S&P 500. It's also in the NASDAQ Composite and the NASDAQ 100. Investors use these indexes to gauge the market, so when NVIDIA moves these indexes, it's directly affecting how investors are viewing the overall market as a whole. That's a crazy thought for a stock with a PE of 58. Yes, investors are paying 58 times earnings for a piece of this tech giant, and will they profit? Well, only if they sell at the right time. Investors are caught up in capital gains excitement right now, and when this happens, the masses seem to forget about boring, stable dividend stocks. Now, I'm not complaining, because when this happens, the markets ignore some of my favorite stocks, and when prices go down, yields go up. That's what I'm here for. However, there are some things that we shouldn't get lost in the flourish, and I'm here watching the other hand. By April, we knew 2025 would be a year full of uncertainties, tariffs, interest rates, executive orders, and all these other things. And we know it would force boards to rethink their forecasts. This could change boards to think about what they're doing with their profits. They could shift away from dividends to greater reinvestment or cash accumulation for a rainy day. And this isn't just limited to cuts or suspensions. For the second quarter, the dollar amount of dividend decreases and suspensions across U.S. domestic common shares totaled $2.3 billion. That was down 44% from the first quarter and down 46% year over year. That looks good. We're seeing less decreases and suspensions, but it's not the whole story. Even though the dollar amount was lower, there were 38 instances of a dividend cut or suspension versus just 21 for the same quarter last year. But wait, there's more. For the second quarter, the dollar amount of dividend increases was $9.8 billion. That was down 49.8% from the first quarter and down 52.1% year over year. So we saw less suspensions and cuts by dollar, but we also saw less increases by dollar as well. The shifting dividend landscape isn't something that the financial mainstream media is really following. They're too focused on these tech giants. But how long is that going to last? Once NVIDIA reports after the market closes today, investors are going to be on to the next thing. Media headlines are already in full speculation about interest rates, and it's not about whether they're going to get cut, it's about whether they're going to get cut in December or in September. Interest rate expectations then trickle through the market and affect the demand for stocks. The yield on the S&P 500 is only 1.25%, and that's actually down from 1.36% last month. It's not hard to find high yield with that as your baseline, but it's more common for dividend investors to use CD rates as a benchmark. When interest rates get cut, that trickles down and investors will take a closer look at dividend stocks. Greater demand for dividend stocks will push their share prices higher, and for those of us that have continued to build during this time, we'll be able to lock in some capital gains. But it also means that attractive entry prices will disappear. Right now, I'm still adding to my positions that investors are punishing unfairly, consumer staples that are being overlooked, shipping companies that have a lot of uncertainty. These are two industries that aren't going to lose their economic importance anytime soon. So I'm curious, are you still adding to your positions right now before the market pivots? What do you consider an above average yield? Do you look at the S&P as a benchmark? Do you use CD rates as a benchmark? Do you use some other number? Let me know in the comments.